like tier one VCs. And if any of them are investing in your round or leading your round, the founders basically, the rest of the industry will write a blank check to them. And I've heard secondhand stories of if Sequoia is leading around, everyone's will put whatever money you want. Everyone wants to be the first, second money in. So after Sequoia invests, they want to be the first money, or after tier one VC invests, they want to be the first.
So they'll write the check after Sequoia, but in a separate round at a higher price.
They could. I've seen some of these investors will write uncapped note. So they'll just at uncapped valuations. When the next round is raised, that's when it's going to convert. And they're taking all the risks today of giving the money of company executing, but they're just hoping that the next round they'll just justify the valuation.
What about founders taking chips off the table during this dynamic?
That's one of the reasons founders also want very high valuations, because if it's a very high valuation, then I can raise more money, even though my company may not need that kind of money. So if I'm raising, let's say, 25 million at a 250 million valuation, my company only needs 20 million. Founders, and in some cases, the teams will take some chips off the table. And there was this whole mania where founders were taking chips off the table at seed round, like in their first round. And many obviously did at Series A and Series Bs, depending on how long they've been working at the company. In some cases, founders would raise round in quick successions, primarily for that reason, because they can take some chips off the table and the company figure things out later.
You had this great line earlier, valuation gets ahead of value. And literally at the seed round, you're getting a 10 million plus valuation. Things got crazier then, to your earlier point, and there's maybe nothing there. A couple slides and a couple founders, but you're getting this value and they're taking money off the table.
It wasn't as common, but it was happening in 2021.
Sign of the times. That was some of the bananas that we saw. So look, there are zombie companies, I call them now, that raised a boatload of money, including, by the way. They raised a boatload of money at an absurd valuation, and they have a ton of cash. And some of them are actually prudently managed. They cut costs. They will never go away. They will never get a public markets exit. They will never get acquired. And they're just out there doing their thing. Who knows how they're marked by the VCs, meaning in their investor presentation to their LPs. Who knows what they're saying the return on that investment is going to be. And there's never going to be a mark because they're never going to raise money. So they can put a finger in the air and say, I think it's what the last price was, and markets are coming back.
I call these companies, the founders are on VC welfare in a way.
Tell me more about this VC welfare.
It's just like I talked to a few founders that raised like 20, 30, 40 million dollars in 2021, 2022. And they were burning, let's say, $1 million a month or something like that. And the revenue wasn't growing as fast, and they were not able to generate enough value for their customers. So what they decided is they are not going to be able to raise the next round. So they cut their team to the bone. Maybe they were 50 people, now they're like 10 people. Barely like the team that's required to keep the product going. Skeleton crew for their existing customers, and whatever organic growth comes, they'll take that, and then they're building a little bit of product along the way. And now they have, I'm just taking an example, now they have, let's say, $20 million in the bank, and they're 10 people burning $2 million a year. They have 10 years of runway. At this point is, do you want to stay on VC welfare? And some founders do, because they're like, at least it's a job. The job market is tough, so it's a job. They're getting paid as founders. They can decide the direction of the company. But the VCs need to say, do I want to be invested in this company for the long run, or do I think that the company is not going to go anywhere? Should I exit the company, sell it to someone for whatever amount, and take all the cash back so I can deploy it somewhere else?
Take your lumps, sell it at a discount. That's the right move that they should be doing. Recognize the loss.
The opportunity cost of money is too high.
And if you're a founder, I don't believe it does make sense, because the point of starting a company is to get an outcome with long-term capital gains that you're not going to get through W-2 income. So yeah, you can work for yourself, but founders work harder than anyone else. So be careful what you wish for. If you're the founder, you're going to have to address everything from customer complaints to closing the sale and everything between, to hiring, you name it. There's a lot to do. So, yeah, a lot of these companies are still around in fintech and crypto, in venture. I spoke with my friend Stephanie Chu at Venture Fund in New York. She said that the valuations had reset, but now they're back. They're coming back, they're elevated. And Y Combinator batches are seeing high valuations once again, like $20 million plus kind of valuation. Not across the board, but often enough.
I think Y Combinator batches always see higher valuations than the market because of the historical success. Again, as I said, it's a power law, and people expect VCs and other folks investing expect that the YC is on the farther end, or they're ahead of the curve in that sense.